Unit 11. Capital and Revenue Expenditure. A capital expenditure is an amount spent to acquire or improve a long-term asset, such as equipment or buildings. Usually, the cost is recorded in an account classified as property, plant, and equipment. The cost, bracket open, except for the cost of land, bracket closed, will then be charged to depreciation expense over the useful life of the asset. A revenue expenditure is an amount that is expensed immediately, thereby being matched with revenues of the current accounting period. Routine repairs are revenue expenditures because they are charged directly to an account such as repairs and maintenance expense. Even significant repairs that do not extend the life of the asset or do not improve the asset, bracket open, the repairs merely return the asset back to its previous condition, bracket close, are revenue expenditures. Difference between capital and revenue expenditure. 1. Capital is large amount, whereas revenue is relatively small. 2. Capital improves or enhances earning capacity, whereas revenue maintains asset. 3. Capital gives long duration benefit, whereas revenue is for short duration. 4. Capital is non-recurring, while revenue is recurring. 5. Capital is balance sheet item, whereas revenue is trading or P&L account item. Capital and revenue expenditure examples. 1. Cost of replacement of defective parts of the machinery is 1. Capital expenditure, 2. Revenue expenditure, 3. Deferred revenue expenditure. It is revenue expenditure. Second, loss of goods due to fire, rupees 8,000 is a revenue expenditure because 1. It is recurring, 2. Amount involved is a small, 3. Losses arising out of business operations. Answer is loss is arising out of business operations. Third, preliminary expenses, discount allowed on are the examples of 1. Capital expenditure, 2. Deferred revenue expenditure, 3. Revenue expenditure. Answer is 2. Deferred revenue expenditure. Fourth, expenditure incurred in acquiring the patent's rights from the business is an example of 1. Capital expenditure, 2. Deferred revenue expenditure, 3. Revenue expenditure. Answer is 1. Capital expenditure. Unit 12. Bills of exchange. A written unconditional order by one party, bracket open, the drawer, bracket close, to another, bracket open, the drawee, bracket close, to pay a certain sum, either immediately, bracket open, a site bill, bracket close, or on a fixed date, bracket open, a term bill, bracket close, for payment of goods and or services received. The drawee accepts the bill by signing it, thus converting it into a post-dated check and a binding contract. It is also called as draft. Promissory note. A financial instrument that contains a written promise by one party to pay another party a definite sum of money either on demand or at a specified future date. A promissory note typically contains all the terms pertaining to the indebtedness by the issuer or maker to the note's payee, such as the amount, interest rate, maturity date, date and place of issuance, and issuer's signature. Promissory notes that are unconditional and saleable become negotiable instruments that are extensively used in business transactions in numerous countries. A promissory note is usually held by the payee. Once the debt has been discharged, it must be cancelled by the payee and returned to the issuer. I repeat, once the debt has been discharged, it must be cancelled by the payee and returned to the issuer. Difference between bill of exchange and promissory note. Bill of exchange, promissory note differences. 1. Bill of exchange, unconditional order. Promissory note, unconditional promise. 2. Bill of exchange, made by creditor, whereas promissory note, made by debtor. 3. Bill of exchange, acceptance by debtor is must, whereas promissory note, no acceptance as such required. 4. Bill of exchange, 3 parties to a bill, whereas promissory note, 2 parties to a bill. 5. Bill of exchange, on dishonor, noting is necessary by notary public, whereas promissory note, noting is not necessary.